Question 1. An individual provides advice about securities, publishes a newsletter, and manages client portfolios for compensation. Under the Investment Advisors Act of 1940, this individual would most likely be defined as an A. Investment Advisor, IA. B. Investment Advisor Representative, IAR. C. Broker-dealer. D. Issuer. Answer. A. Investment Advisor. IA. An investment advisor. IA is generally defined by the ABC test, providing advice about securities, doing so as a business, and receiving compensation. The individual in the question meets all three criteria by providing advice, publishing a newsletter, a form of advice, managing portfolios, and receiving compensation. This definition distinguishes IAs from other market participants like broker-dealers or issuers, who may also interact with securities but under different primary functions. Understanding this core definition is fundamental to Series 65 material. Question 2. Which of the following is not an exclusion from the definition of an investment advisor under the Investment Advisors Act of 1940? A. A bank or bank holding company. B. A lawyer whose advice about securities is solely incidental to the practice of law. C. A person whose advice is limited solely to U.S. government securities. D. A publisher of a bona fide newspaper of general and regular circulation. Answer. C. A person whose advice is limited solely to U.S. government securities. While some entities are excluded from the definition of an investment advisor, a person whose advice is limited solely to U.S. government securities is not among them. In fact, providing advice on any type of security, including government securities, can subject one to IA registration if the ABC test is met. Banks, lawyers, accountants, teachers, and engineers, L.A.T.T.E., whose advice is incidental to their primary profession are excluded, as are publishers of bona fide publications. Broker-dealers and IARs are also excluded if their advice is solely incidental to their brokerage business. It's crucial to differentiate between an exclusion from the definition and an exemption from registration. Question 3. Under the Uniform Securities Act, which of the following would be exempt from state registration as an investment advisor? A. An advisor with no place of business in the state whose only clients are investment companies. B. An advisor with a place of business in the state whose only clients are individuals. C. An advisor registered with the SEC. D. An advisor with a place of business in the state whose only clients are trusts. Answer. A. An advisor with no place of business in the state whose only clients are investment companies. Under the Uniform Securities Act, an investment advisor is exempt from state registration if they have no place of business in the state and their only clients are institutional investors like investment companies, other investment advisors, broker-dealers, or employee benefit plans with assets over $1 million. This is known as the institutional exemption. An advisor registered with the SEC, a federal covered advisor, is also exempt from state registration due to federal preemption under NSMIA, regardless of whether they have a place of business in a state. However, they may be required to notice file in states where they have a place of business. The de minimis exemption applies to state-registered IAs with no office in a state and fewer than 6 retail clients. The other options describe scenarios that would generally require state registration. Question 4. An investment advisor. IA, with $150 million in assets under management, AUM, is generally required to register with A. The State Securities Authority only. B. The Securities and Exchange Commission, SAC, only. C. Both the state and the SEC. D. FINRA. Answer, B. The Securities and Exchange Commission, SEC, only. Under the Dodd-Frank Act, an investment advisor generally registers with the SEC if they have $100 million or more in assets under management, AUM, unless a specific exemption applies. Advisors with less than $100 million AUM typically register with the State Securities Authority. Advisors with $150 million AUM are considered federal covered advisors and register exclusively with the SEC, which preempts state registration requirements. FINRA does not register investment advisors, only broker-dealers and their representatives. Question 5. Which of the following individuals would be required to register as an investment advisor representative, IAR, under state law? A. An employee who provides only clerical support to an investment advisor. B. A partner who manages client accounts and determines suitability of recommendations. C. An individual who solely publishes a financial newsletter providing general market commentary. D. A broker-dealer's agent whose advice is solely incidental to executing transactions. Answer, B. A partner who manages client accounts and determines suitability of recommendations. An investment advisor representative, IR, is an individual who represents an investment advisor in performing functions such as managing accounts, soliciting advisory services, or determining the suitability of recommendations. A partner managing client accounts and determining suitability clearly falls within this definition. Clerical staff are typically excluded, as is a publisher of a general financial newsletter, who may be an IA but not necessarily an IAR of a registered IA unless they also perform IAR functions. A broker-dealer's agent whose advice is solely incidental is typically excluded from the definition of an IAR as long as they are acting within the scope of their brokerage activities. Question 6. An investment advisor representative, IAR, is moving from State A to State B. The IAR must A. Notify FINRA of the change within 30 days. B. Re-register in State B and notify State A of the termination. C. Only notify the SEC of the change, as IAR registration is federal. D. Take the Series 65 exam again for State B. Answer, B. Re-register in State B and notify State A of the termination. When an IAR moves states, they must terminate their registration in the former state, State A, and re-register in the new state, State B, where they will be conducting business. This is because IAR registration is generally state-specific. The employing investment advisor typically handles the filing of Form U4, for registration, and Form U5, for termination, on behalf of the IAR. IAR registration is primarily regulated at the state level, not by FINRA or solely by the SEC. Retaking the exam is usually not required unless there's a significant lapse in registration. Question 7. The primary duty of an investment advisor, IA, to its clients is A. To ensure that all investment recommendations are profitable. B. To act in a fiduciary capacity, always putting the client's interests first. C. To execute client trades efficiently and at the best available price. D. To disclose all conflicts of interest after a transaction has occurred. Answer, B. To act in a fiduciary capacity, always putting the client's interests first. Investment advisors are held to a fiduciary standard, which means they must always act in the best interests of their clients, placing the client's interests before their own. This standard is higher than the suitability standard that applies to broker-dealers. While efficient trade execution and disclosure of conflicts are important, they are components of fulfilling the broader fiduciary duty. Ensuring profitability is impossible and not a duty of an IA. This core principle differentiates the IA's role from that of other financial professionals. Question 8. An investment advisor, IA, makes a recommendation to a client knowing that the IA firm plans to take a substantial position in the same security shortly thereafter. This practice is known as A. Churning, B. Trading ahead, C. Front-running, D. Backdating. Answer, C. Front-running. This unethical practice is known as front-running, where an investment professional executes trades for their own account or the firm's account with prior knowledge of a pending client order or recommendation that is expected to move the market. This allows the professional to profit from the anticipated price movement at the expense of the client. Churning involves excessive trading to generate commissions, and trading ahead is similar to front-running but often refers to a broker-dealer executing proprietary trades before client orders. Front-running is a serious breach of fiduciary duty and is prohibited. Question 9. An investment advisor representative, IR, recommends a series of transactions to a client that are excessive in size and frequency, primarily to generate higher commissions for the firm. This unethical practice is called A. Painting the tape, B. Churning, C. Selling away, D. Market manipulation. Answer, B. Churning. Churning refers to the unethical and illegal practice where an investment advisor or broker-dealer engages in excessive trading in a client's account solely to generate commissions, without regard for the client's investment objectives. This practice directly violates the fiduciary duty to act in the client's best interest. Painting the tape and market manipulation are broader forms of illegal market activity, while selling away involves an agent executing securities transactions outside the scope of their employment with their firm. Churning specifically targets the misuse of client accounts for personal gain through excessive trading. Question 10. Regarding investment advisory contracts, the Investment Advisors Act of 1940 requires all of the following except A. Contracts must be in writing. B. No assignment of the contract without client consent. C. If the IA is a partnership, clients must be notified of any change in partners. D. Prohibition of performance-based fees, with certain exceptions. Answer. A. Contracts must be in writing. The Investment Advisors Act of 1940 does not explicitly require advisory contracts to be in writing, although it is best practice and often required by state law. It does, however, prohibit the assignment of an advisory contract without the client's consent, mandate client notification of changes in partnership for IA firms, and generally prohibit performance-based fees unless specific exceptions are met, e.g., for qualified clients. This illustrates a key distinction between federal and state requirements, as most states do require written contracts. Question 11. An investment advisor, IA, enters into a soft dollar arrangement with a broker-dealer. Which of the following would generally be considered an acceptable soft dollar expense? A. Office rent and administrative salaries for the IA firm. B. Client referrals to the IA from the broker-dealer. C. Proprietary research reports provided by the broker-dealer to the IA. D. Marketing and entertainment expenses for the IA's clients. Answer, C. Proprietary research reports provided by the broker-dealer to the IA. Soft dollar arrangements involve an IA directing client brokerage transactions to a broker-dealer in exchange for research and brokerage services. For an expense to be considered acceptable under the safe harbor of Section 28(e) of the Securities Exchange Act of 1934, it must generally be a product or service that assists the IA in its investment decision-making process for the benefit of its clients. Proprietary research reports fit this criterion. Conversely, office rent, administrative salaries, client referrals, and marketing expenses are not considered acceptable soft dollar expenses as they do not directly aid in the investment decision-making process. The IA must disclose these arrangements to clients. Question 12. Which of the following would not cause an investment advisor? IA. To be deemed to have custody of client funds or securities. A. Accepting third-party checks from clients and forwarding them to a qualified custodian within 3 business days. B. Holding client funds or securities in a bank account under the IA's name. C. Having full power of attorney over a client's account, allowing the IA to withdraw funds. D. Receiving a client's physical stock certificates and placing them in the IA's office safe. Answer. A. Accepting third-party checks from clients and forwarding them to a qualified custodian within 3 business days. An investment advisor is deemed to have custody if they hold client funds or securities, or have the authority to obtain possession of them. Accepting a third-party check, a check made out to a third party, and promptly forwarding it to a qualified custodian, within 3 business days, is typically an exception and does not, by itself, constitute custody. However, holding client funds in the IA's own account, having full power of attorney to withdraw funds, or taking physical possession of securities, even temporarily in an office safe, would all constitute custody. Custody triggers significant additional regulatory requirements to protect client assets. Question 13. An investment advisor, IA, is required to deliver a Form ADV Part 2A, brochure, to a prospective client. A. Annually, within 90 days of the end of the IA's fiscal year. B. At least 48 hours before entering into an advisory contract, or at the time of contract if the client has a 5-day free look period. C. Only upon specific client request. D. Within 30 days of the client opening an account. Answer, B. At least 48 hours before entering into an advisory contract, or at the time of contract if the client has a 5-day free look period. The brochure rule requires an investment advisor to deliver Form ADV Part 2A, and Part 2B, if applicable, to a prospective client either at least 48 hours before entering into an advisory contract or at the time of entering into the contract if the client has a right to terminate the contract without penalty within 5 business days. This ensures clients receive crucial information about the IA's services, fees, and conflicts of interest before making a commitment. Annual updates are also required, but the initial delivery rules are specific to the onboarding process. Question 14. An investment advisor, IA, would generally be permitted to charge a performance fee, a fee based on a share of capital gains or appreciation, to which of the following clients? A. An individual with a net worth of $500,000. B. An employee benefit plan with assets of $50,000. C. A natural person with at least $1 million under management with the IA. D. Any client, provided the fee is fully disclosed in Form ADV. Answer, C. A natural person with at least $1 million under management with the IA. Under the Investment Advisors Act of 1940, performance fees are generally prohibited due to potential conflicts of interest, but there are specific exceptions for qualified clients. A qualified client is defined as someone who has at least $1 million under management with the IA or has a net worth exceeding $2 million, excluding the value of their primary residence. An individual with $1 million under management with the IA meets one of these thresholds. These thresholds are adjusted periodically for inflation. Disclosing the fee is not sufficient, the client must meet the qualified client criteria. Question 15. An investment advisor, IA, must retain records of client communications, including emails, for a minimum of how many years? A. 2 years. B. 3 years. C. 5 years. D. 6 years. Answer, C. 5 years. Under the Investment Advisors Act of 1940, registered investment advisors are generally required to maintain most records, including client communications such as emails, for a period of 5 years. The first 2 years of these records must be kept in an easily accessible location. This rule ensures that regulatory authorities can review an IA's compliance with securities laws and regulations, protecting client interests and maintaining market integrity. State regulations often mirror or align with these federal requirements. Question 16. Which of the following is considered an asset on a company's balance sheet? A. Accounts payable. B. Retained earnings. C. Inventory. D. Bonds payable. Answer, C. Inventory. A company's balance sheet presents its financial position at a specific point in time, following the accounting equation. Assets equals liabilities plus equity. Assets are resources owned by the company that have future economic value. Inventory, representing goods available for sale, is clearly an asset. Accounts payable and bonds payable are liabilities, representing obligations to others, while retained earnings is an equity account, representing accumulated profits not distributed to shareholders. Question 17. Which of the following is a key characteristic of preferred stock? A. Voting rights proportional to shares owned. B. Fluctuating dividend payments based on company performance. C. Fixed dividend payments and preference in liquidation over common stockholders. D. Higher potential for capital appreciation than common stock. Answer, C. Fixed dividend payments and preference in liquidation over common stockholders. Preferred stock typically carries fixed dividend payments, meaning the dividend amount does not fluctuate with company earnings. In the event of liquidation, preferred stockholders have a claim on the company's assets before common stockholders, making them senior in terms of payment. Unlike common stock, preferred stock generally does not have voting rights and often has limited potential for capital appreciation, as its price is more sensitive to interest rate changes than growth prospects. Its preferred status comes from these dividend and liquidation preferences. Question 18. An investor seeking current income with minimal principal fluctuation would most likely invest in A. Growth stocks. B. Long-term government bonds. C. Short-term municipal bonds. D. Speculative options. Answer, C. Short-term municipal bonds. For an investor seeking current income with minimal principal fluctuation, short-term municipal bonds are often a suitable choice. They provide regular, often tax-exempt interest payments, and their short duration makes them less sensitive to interest rate changes, thus minimizing principal fluctuation compared to long-term bonds. Growth stocks offer potential capital appreciation but typically pay little or no income and are highly volatile. Speculative options are high-risk instruments not suited for income or principal preservation. Long-term government bonds offer income but are subject to significant interest rate risk, leading to principal fluctuations. Question 19. The yield to maturity, YTM, of a bond reflects A. The annual interest rate paid by the bond's issuer. B. The return an investor would receive if they held the bond until its maturity date, taking into account its current market price, par value, coupon interest rate, and time to maturity. C. The income generated by the bond, expressed as a percentage of its current market price. D. The discount rate that equates the bond's market price to its par value. Answer, B. The return an investor would receive if they held the bond until its maturity date, taking into account its current market price, par value, coupon interest rate, and time to maturity. The yield to maturity, YTM, is the total return an investor expects to receive if they hold a bond until it matures. It accounts for the bond's current market price, its par value, the coupon interest rate, and the time remaining until maturity. YTM is a more comprehensive measure of a bond's return than just its coupon rate or current yield because it factors in any capital gain or loss if the bond was purchased at a premium or discount. Understanding YTM is crucial for comparing different bonds and evaluating their true profitability over their remaining life. Question 20. Which of the following describes the relationship between bond prices and interest rates? A. They move in the same direction. B. They move in opposite directions. C. There is no direct relationship. D. Bond prices are only affected by the issuer's credit rating, not interest rates. Answer, B. They move in opposite directions. Bond prices and interest rates have an inverse relationship. When prevailing interest rates rise, newly issued bonds offer higher coupon rates, making existing bonds with lower coupon rates less attractive. To compensate for their lower yield, the market price of existing bonds must fall to make them competitive. Conversely, when interest rates fall, existing bonds with higher coupon rates become more attractive, causing their market prices to rise. This sensitivity is known as interest rate risk and is a fundamental concept in bond investing. Question 21. A unit investment trust, UIT, is characterized by A. Active management and continuous trading of its portfolio. B. A fixed portfolio of securities that is not actively managed, with units redeemable at net asset value. C. The ability to issue new shares continuously and reinvest dividends automatically. D. A management team that seeks to outperform a specific market index. Answer, B. A fixed portfolio of securities that is not actively managed, with units redeemable at net asset value. A unit investment trust, UIT, is an investment company that offers a fixed portfolio of securities, typically bonds or stocks, for a specified period. Unlike mutual funds, a UIT's portfolio is not actively managed, it remains static from its inception until its termination date. Units of a UIT are redeemable at their net asset value, NAV, and are not traded on secondary markets. This structure makes UITs suitable for investors seeking a predictable income stream from a diversified, unmanaged portfolio. Question 22. A mutual fund's expense ratio represents A. The sales charge paid to purchase fund shares. B. The percentage of total assets deducted annually for fund operating expenses. C. The advisory fee charged by the fund's portfolio manager only. D. The total commissions paid on portfolio trades. Answer, B. The percentage of total assets deducted annually for fund operating expenses. The expense ratio of a mutual fund is a key metric representing the percentage of a fund's total assets that are used to cover operating expenses annually. These expenses typically include management fees, administrative fees, custodial fees, and 12b-1 fees, if applicable, but generally exclude trading costs and sales charges. A lower expense ratio is generally more favorable for investors, as it means a larger portion of their investments' returns is retained. Understanding the expense ratio is crucial for assessing the true cost of owning a mutual fund. Question 23. What is a primary advantage of exchange-traded funds, ETFs, over traditional open-end mutual funds? A. ETFs are always actively managed, offering higher potential returns. B. ETFs can be bought and sold throughout the day on an exchange at market-determined prices. C. ETFs typically have higher expense ratios than mutual funds. D. ETFs can only be purchased directly from the fund company. Answer, B. ETFs can be bought and sold throughout the day on an exchange at market-determined prices. A primary advantage of exchange-traded funds, ETFs, is their tradability, they can be bought and sold on stock exchanges throughout the trading day, similar to individual stocks, at prices determined by supply and demand. In contrast, traditional open-end mutual funds are priced once per day at their net asset value, NAV, at the end of the trading day. While many ETFs are passively managed, some are actively managed. ETFs often have lower expense ratios than actively managed mutual funds and are typically bought and sold through broker-dealers, not directly from the fund company. Question 24. An investor buys 100 shares of XYZ stock at $50 per share and simultaneously buys one XYZ $50 put option contract for a premium of $3. This strategy is known as A. Covered call. B. Protective put. C. Long straddle. D. Short strangle. Answer, B. Protective put. This strategy is a protective put, often referred to as portfolio insurance. The investor owns the underlying stock, long 100 shares of XYZ, and simultaneously buys a put option on that same stock. The put option provides a right to sell the stock at the strike price, $50, thereby limiting the potential downside loss on the stock, regardless of how far the stock price falls below $50. The cost of this protection is the premium paid for the put. This strategy is ideal for investors who want to protect gains or limit losses on a stock they already own. Question 25. A client is concerned about inflation eroding the purchasing power of their fixed income investments. Which of the following investments would offer the best protection against inflation? A. Treasury bills, T-bills. B. Treasury bonds, T-bonds. C. Treasury inflation-protected securities, TIPS. D. High-yield corporate bonds. Answer, C. Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are specifically designed to protect investors from inflation. Their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI, and the coupon interest payments are then paid on this inflation-adjusted principal. This mechanism ensures that both the income stream and the principal value keep pace with inflation. T-bills and T-bonds, while safe, do not offer direct inflation protection. High-yield corporate bonds carry significant credit risk and do not offer inflation protection. Question 26. Which of the following bond features would result in a lower coupon rate at issuance, all else being equal? A. A lower credit rating of the issuer. B. A longer time to maturity. C. A put feature allowing the bondholder to sell the bond back to the issuer. D. A call feature allowing the issuer to redeem the bond before maturity. Answer, C. A put feature allowing the bondholder to sell the bond back to the issuer. A bond with a put feature is more attractive to investors because it provides them with the option to sell the bond back to the issuer at par value if interest rates rise or the issuer's credit quality deteriorates. This reduces the investor's risk, allowing the issuer to offer a lower coupon rate to compensate. Conversely, a lower credit rating, a longer time to maturity, or a call feature would typically require a higher coupon rate to attract investors due to increased risk or issuer advantage. Question 27. Which of the following statements regarding a Roth IRA is true? A. Contributions are tax-deductible. B. Withdrawals in retirement are tax-free, provided certain conditions are met. C. There are no income limitations for making contributions. D. Required minimum distributions, RMDs, must begin at age 73. Answer, B. Withdrawals in retirement are tax-free, provided certain conditions are met. A key advantage of a Roth IRA is that qualified withdrawals in retirement are completely tax-free, including both contributions and earnings, provided the account has been open for at least 5 years and the owner is at least 59 and a half, disabled, or using the funds for a first-time home purchase. Contributions to a Roth IRA are made with after-tax dollars and are therefore not tax-deductible. There are income limitations for making direct contributions, and unlike traditional IRAs, Roth IRAs do not have required minimum distributions, RMDs, for the original owner during their lifetime. Question 28. An investor wishes to understand the risk-adjusted return of their portfolio relative to the market. Which measure would be most appropriate? A. Alpha. B. Beta. C. Standard deviation. D. Sharpe ratio. Answer, D. Sharpe ratio. The Sharpe ratio is the most appropriate measure to assess a portfolio's risk-adjusted return. It calculates the excess return above the risk-free rate, per unit of total risk, standard deviation. A higher Sharpe ratio indicates better risk-adjusted performance. Alpha measures the excess return relative to the return predicted by its beta, indicating the value added by the manager. Beta measures systematic risk or market sensitivity, while standard deviation measures total risk but doesn't adjust for return. Therefore, the Sharpe ratio provides a comprehensive view of how much return an investor is getting for the risk taken. Question 29. Modern portfolio theory, MPT, suggests that investors can optimize their portfolios by combining assets in a way that A. Maximizes return without considering risk. B. Minimizes risk for a given level of return, or maximizes return for a given level of risk. C. Focuses solely on individual asset performance, ignoring correlation. D. Invests only in risk-free assets. Answer, B. Minimizes risk for a given level of return, or maximizes return for a given level of risk. Modern portfolio theory, MPT, emphasizes diversification to optimize portfolios. It posits that investors can achieve the best possible portfolio performance by strategically combining assets to either minimize overall portfolio risk for a specified expected return or maximize expected return for a given level of risk. This optimization is achieved by considering the correlation between different assets, not just their individual performance. MPT seeks to identify the efficient frontier, representing portfolios with the highest return for each level of risk, or the lowest risk for each level of return. Question 30. Which of the following is true regarding asset allocation? A. It is the process of selecting individual securities within specific asset classes. B. It primarily focuses on short-term market timing strategies. C. It involves distributing an investment portfolio among different asset categories to reflect an investor's risk tolerance and investment objectives. D. It guarantees superior returns compared to non-diversified portfolios. Answer, C. It involves distributing an investment portfolio among different asset categories to reflect an investor's risk tolerance and investment objectives. Asset allocation is the strategic process of dividing an investment portfolio among various asset categories, such as stocks, bonds, and cash, based on an investor's specific risk tolerance, investment goals, and time horizon. Its primary aim is to manage risk and return by diversifying across different asset classes that often behave differently under varying market conditions. While it aims to optimize risk-adjusted returns, it does not guarantee superior returns, nor is it focused on selecting individual securities, that's security selection, or short-term market timing. Question 31. An investor bought a bond for $980. It has a par value of $1,000 and pays a 5% coupon annually. If the investor sells the bond for $1,020 before maturity, what is the capital gain? A. $20. B. $40. C. $50. D. $70. Answer: B. $40. Capital gain or loss is calculated as the difference between the selling price and the original purchase price. In this scenario, the investor bought the bond for $980 and sold it for $1,020. The capital gain is $1,020, selling price, $980, purchase price, equals $40. The bond's par value and coupon rate are relevant for calculating interest income but not for determining the capital gain on the sale itself. This calculation is fundamental for understanding investment returns and tax implications. Question 32. An investment advisor representative, IR, is developing an investment policy statement, IPS, for a client. Which of the following elements would typically be included? A. Detailed list of every security the client should purchase. B. A guarantee of minimum returns for the portfolio. C. Client's investment objectives, risk tolerance, and asset allocation guidelines. D. The IAR's personal financial goals and investment strategies. Answer: C. Client's investment objectives, risk tolerance, and asset allocation guidelines. An investment policy statement, IPS, is a crucial document that formalizes the client-advisor relationship and outlines the framework for managing the client's portfolio. It typically includes the client's investment objectives, e.g., growth, income, risk tolerance, time horizon, liquidity needs, and specific asset allocation guidelines. An IPS does not include a detailed list of every security, nor does it guarantee returns, which would be unethical and illegal. It also focuses on the client's financial goals, not the IAR's personal objectives. Question 33. When recommending a variable annuity to a client, an investment advisor representative, IR, must ensure the recommendation is suitable. Which of the following client characteristics is least relevant to the suitability of a variable annuity? A. Client's investment time horizon. B. Client's desire for tax-deferred growth. C. Client's income tax bracket. D. Client's favorite color. Answer: D. Client's favorite color. Suitability requires an IAR to recommend investments that are appropriate for a client's specific financial situation, investment objectives, and risk tolerance. While investment time horizon, desire for tax-deferred growth, and income tax bracket are all highly relevant factors when considering a variable annuity, due to their long-term nature, tax deferral, and impact on tax efficiency, a client's favorite color has absolutely no bearing on the financial appropriateness or suitability of any investment product. This highlights the importance of focusing on financial and investment-related client characteristics for suitability. Question 34. An investment advisor, IA, calculates the present value of a future cash flow. Which of the following would result in a lower present value? A. A lower discount rate. B. A shorter time period until the cash flow is received. C. A higher future cash flow amount. D. A higher discount rate. Answer: D. A higher discount rate. The present value of a future cash flow is inversely related to the discount rate and the time period. A higher discount rate, representing a higher required rate of return or greater perceived risk, will reduce the present value of a future cash flow, as the future money is discounted more heavily. Conversely, a lower discount rate or a shorter time period until receipt would result in a higher present value. A higher future cash flow amount would naturally lead to a higher present value, assuming other factors remain constant. Understanding the time value of money and its components is critical for valuation. Question 35. A client with a high risk tolerance and a long time horizon would generally find which of the following investment strategies most suitable? A. Investing primarily in money market instruments for capital preservation. B. A balanced portfolio of 70% bonds and 30% equities for current income. C. A portfolio heavily weighted towards growth stocks and emerging market equities for capital appreciation. D. Investing solely in immediate annuities for guaranteed lifetime income. Answer: C. A portfolio heavily weighted towards growth stocks and emerging market equities for capital appreciation. For a client with a high-risk tolerance and a long time horizon, a strategy focused on capital appreciation through growth-oriented investments, such as growth stocks and emerging market equities, would be most suitable. These investments typically carry higher risk and volatility but offer the potential for significant long-term returns, which aligns with a long time horizon and high-risk tolerance. Money market instruments, balanced portfolios heavy in bonds, and immediate annuities are typically more suited for investors with lower risk tolerance, shorter time horizons, or a primary need for income and capital preservation.